Coming up today, stocks continue to slide. The Nasdaq falls into correction territory. A war of words erupts from Besson. Are we heading towards a recession? Does Trump even care about the market anymore? And why tomorrow could be a make or break day for the market. This is where it gets interesting, guys. Let's go. And welcome back, everybody, on another rough day in the stock market. Growth shares taking us lower again here today. Inductors and other tech shares out there taking it on the chin. We got Netflix down over 8%. Financials still getting hit hard. And it was actually energy that held ground today, along with a few consumer defensives as well. However, stick with me today because I'll make a case to you why I still think this is a tradable bottom with a likely recovery just around the corner here as we continue to be very technically oversold on the indices, especially in the Magnificent 7 stocks, collectively down 3% today. Now as a group, 10% below 50-day VWAP. And just looking at my S&P 500 oscillator, still currently in oversold territory as well. However, we're still in what I've been calling the dicey zone, as we can see here with this red shade on the chart. And part of that has to do with the volatility term structure still being in backwardation. In fact, we've got option dealers pricing in volatility at 31 for tomorrow, meaning tomorrow could be a big day in the markets, up or down. We got the jobs report first thing out in the morning. If that would have come in weaker than expected, it would be a good excuse for the algos to rug pull the market again. And I'm sure on the back of all those negative headlines, more and more investors will be fleeing this market. But like I've been saying, the market was vulnerable to do this as long as this spread here remains above 1. The difference between the front month and the second month. VIX futures contract, what I'm calling the dicey zone. Good news is it could be nearing exhaustion as we've now got the 4th consecutive reversal signal. Last time we saw that was back in October, right near the peak before things calmed down again. So we won't know we've hit a bottom until this spread goes back below 1. And we can see on the VIX itself, this move has been very persistent, but could be nearing the end, although we very well could have one more last sharp and nasty spike, give us that capitulation, and then we find that low. But like I said, stick with me because we'll also look underneath the hood of the economy at a dozen plus economic indicators right here in TradingView to give you a bird's eye view of all the trends and whether things are really as bad as they're made out to be. And just to give you a quick preview of that, looking at the Kansas City Financial Stress Index and also the St. Louis Fed Financial Stress Index. Financial conditions are still very easy. So financial markets, credit markets, liquidity, they're not splitting apart here. In fact, why in my opinion it's still a buying opportunity is because I think financial conditions are now easing even further. We've got the dollar coming off, rates have come down, and so has oil. This is everything the new Treasury Secretary, Scott Besson, has wanted to achieve. To help out America's finances, its debt situation, and power further economic growth. These are all the big key inputs, the dollar, rates, and oil. And along with technical oversold conditions, it sets up for a potentially good bounce in Q2 for tech and other growth assets. Because we've also got global liquidity on the rise, which I'll get into later as well. Everything happening in Europe and Germany. There's a lot of moving parts out there, but for the here and now, most investors are very nervous and scared. Extreme fear. Getting lower again today, down to 17. Nasdaq now technically in correction levels, off more than 10% from highs. The Russell 2000 flirting with what they technically call a bear market, down 20% from highs. With plenty of growth stocks down more than that, 20, 30, even 40%. No doubt this is a sharp and swift correction in the market here with some growth scares. And probably fueling that even further today was Trump confirming what we've been saying lately. He's not so focused on the stock market in his second term. As I've been saying, he's willing to tolerate some volatility. And in my opinion, he won't pull out the Trump put unless things get really bad, maybe down 20% or more. Because right now, he's determined to go ahead with his America First mandate, along with his team firmly on board as well. Even though we're already getting some of the tariffs on Mexican and Canadian goods delayed somewhat. This is a real back and forth situation here. They're obviously playing hardball to try and prompt their largest trading partners into doing deals and lowering tariffs on US goods. Because let's just keep in mind, the States has the lowest average tariff rate against all of its major trading partners. Trump and his team are determined to level that playing field in the interest of American companies and the American economy at large, which I think they will eventually achieve, even though it's getting a little messy here in the short term, in the markets at least anyway. But they are determined. We got some big words coming out of the Treasury Secretary, Scott Besson, saying the US will collapse Iran's economy by shutting down its oil industry, aiming to slash Iran's oil exports to a trickle. Going on to say, if I were Iranian, I would get all my money out of the rial now. Making Iran broke again will mark the beginning of our updated sanctions policy, as the previous admin were unsuccessful in getting them to dial down their nuclear threats. Paying them off a couple $100 billion didn't work. They just funneled that into their proxies in the region, kicking off things in Israel. But it's not just the Iranians. Scott Besson labeling Canada's Prime Minister, Justin Trudeau, a numbskull, and tried to encourage him to come to the negotiating table, even saying they have his phone number. He's happy to have a discussion with them because their mandate is to re-privatize the economy, reinvigorate the private sector, and shrink the government sector. which, like I said, medium and especially long term, is very much needed as the states have been on an unsustainable path. It was always going to come with some short term volatility and pain. These are big changes. Makes for good fodder for the financial media to pile in on, even throwing the R word around now, believing all this could lead us into a recession. If not, some saying we'll get stagflation. Just keep in mind how rare stagflation actually is. Seen that happen less than 4% of the time, where economic growth grinds to a halt, where we've still got persistent inflation. It's really back in the 70s we last had stagflation, but it is causing a big correction in growth stocks. NVIDIA, one of the poster childs for this AI boom, under pressure here. And unbelievably, we've now got NVIDIA's forward PE at 26, implying a forward earnings yield about 4%, and that's less than Apple's. Apple's growth has flatlined the last couple of years. We even had a few negative quarters in there. NVIDIA just came out 73% year-over-year growth in earnings. We're now down at the bottom end of the range in NVIDIA's forward PEs back over the last decade. And the stock is now down over 27% from highs. I'm still patiently waiting to see if I can pick up a few shares for $103, which we very well could get there over the coming days. And Tesla as well, continuing to slide lower again here today, getting down to 260. Got the bottom of that earnings gap up day at 242. We'd have to trade down to about 213 to close that gap. And I'd like to pick up a few more shares at 220 if I could. And as the new Model Y begins to roll out around the world, could be already seen some early green shoots. Just got news. Tesla deliveries in the United Kingdom for February up over 21% year over year. Goes in the face of that recent narrative, doesn't it? That things are falling off a cliff there. Consumers are holding off the new Model Y. And I still believe this is shaping up to be a great buy the dip opportunity on Tesla, even if we do come to 220. Also seen some sharp falls in other big stocks. Netflix down 8.5% today. And other chip stocks like Marvel Technology down 20% on their earnings. We did just get good news from Broadcom, who just released their earnings, coming in a bit better than expected. Stocks trading up 15% after hours. And just looking at the semiconductor sector ETF, getting some buy signals here, as many key markets still looking to find some support, and the spread between high beta stocks and low volatility. It too, also trying to find support here. It didn't get down as low as we did on Tuesday, but like I said, looking at the VIX one-day index, tomorrow could be a monster day on the back of the jobs report, along with Jay Powell speaking afterwards as well. But we do have a glimmer of hope out there. Kramer coming out and saying the selling's not over yet. Very well could be close to a bottom here, which wouldn't surprise me because what really drives the stock market is continuing to trend higher, and that's corporate earnings. Just looking at the S&P 500, earnings in 23 were 221 points, 24, 246 points. They're expected to be 285 points this year. Ed Yardeni expecting 320 next year. The rest of the street a little bit lower, 308. So if we just go a little bit in between the street and Ed Yardeni, who's actually been calling the market a lot more correctly, not only of late, but for most of his career. He's a big believer in the roaring 20s, as am I. We currently got the S&P 500 at 57.38. So let's do a little math here. 57.38 on the S&P. Now let's estimate S&P earnings at 310 points for next year. We divide that by 310, gives us a forward PE of 18.5. And in other words, that's an earnings yield of 5.4%. Or you could lend your money to the government for 1 year and they'll pay you a bit over 4%. And that's not growing like the stock market. And in fact, if yields bump back up, your bonds will be worth less if you don't hold them to maturity. So the yield differential between stocks and bonds is improving in favor of stocks. Remember, everything in investing is relative. You don't invest in a vacuum. If we could get 10% on T-bills, this wouldn't even be a conversation. I would say go out there and just buy T-bills. You're getting double the yield of the stocks. However, that's simply not the case here. And let's not forget the huge amount of liquidity sloshing around out there. Almost 7 trillion in money market funds. And if the Fed is able to cut rates once or twice more, all this money is going to be yielding a lot less. Where do you think it might go to find a home? And just look at that huge increase ever since Q1 2020, going up 2.5 trillion. A lot of dry powder on the sidelines here. And the market could very well follow a similar path to Trump's first term. Back in 2018, 2019, we got a bit of volatility on similar headlines. The fears didn't play out. We didn't get huge spikes in inflation. Global economy didn't get toppled, nor did the US economy. But there was plenty of volatility out there. But fear not, if things get bad enough, the Trump put will kick in and he'll feed a few positive headlines to the market to give us a bounce. Along with the Fed probably coming out dovish and dialing up quantitative easing. But for the here and now, they're in a bit of a wait and see mode with these tariffs. They're worried about potential upticks in inflation. But if markets keep getting weaker, they very well could goose the Fed into trimming again. We're pretty much 50-50 here, whether the Fed cuts the next time they meet after this month in May. And like I said, that's going to bring down the yield on that 7 trillion in money market funds. And if the S&P keeps going even lower, well, its relative yield is going to keep getting more appealing because the rest of the world is still in a monetary easing cycle. ECB just cut rates again. The rest of the world's really worried worried about what the Trump team is doing. And they should be, because a lot more of their exports go to the States and vice versa. They have much more to lose. And now they're talking about hundreds of billions of dollars and new stimulus packages, new defense spending, because it'll no longer be the US taxpayer paying for European security. Historically footing the majority of NATO's bill, not to mention directly financing almost everything going on in Ukraine. Let's not forget about China either. They're dialing up the stimulus. They're already in a soft, vulnerable spot. Their economy much more dependent on exporting to the States than vice versa. That's why they've only softly bit back. They don't want it to dial up, but at least for now, these other countries aren't seemingly willing to get a deal done right away, so Trump's putting the squeeze on them, which interestingly enough, Chinese and European securities are actually outperforming this year. China actually traded up again today, and the Euro Stoxx 50 index, kind of like the S&P for the Eurozone, also having a good start to the year and holding ground here, as plenty of global investors are worried. Bit of a rotation out of US assets. Moving on from the macro, we got Walgreens on the way to going private, one of the biggest leverage buyouts in the past decade, with PE firm Sycamore, $10 billion deal, agreeing to pay $11.45 a share. Shareholders could also receive up to additional $3 a share down the road, based on proceeds from selling the company's private care assets. Deal's expected to close in the fourth quarter of 25, and they'll strip it down to a much smaller size and probably do what private equity firms are good at doing, extracting maximum profit, saddling it with debt again, and then flipping it back onto the market in a few years, or get some other big conglomerate to take it over. Got the news after hours, so we're trading up a bit here. 11.22, which with a buyout at 11.45 divided by 11.22, 2% of premium, and it's not going to close to the fourth quarter. That is not much reward for something that could potentially go wrong, but I guess there's also the upside of further payments to shareholders, but that could take quite some time as well. But there were some clues looking at the chart. These big fat green candles, probably the private equity firm themselves gobbling it up, and that's why we pay attention to the technicals, because the big players do leave some footprints that us smaller investors can key off. Okay, just moving on to what I alluded to earlier. I'm going to look at some economic indicators here in TradingView on long-term monthly line charts. And here's another one, the Chicago Fed financial conditions. There was that spike in COVID, big one in the GFC. We'd already started climbing early 2007, even though the market didn't really roll over to late 07, early 08. Right here, things are still very low. Actual conditions are not as bad as what they seem, leading me to believe this could be a growth scare and fear spike. But no doubt consumer confidence is low. Consumers are worried about what's around the corner. A lot of them still struggling with embedded inflation. So no doubt there is some fear out there for the here and now. Some others looking a bit better. Consumer sentiment from UMISH, well off those lows from 22. We saw a good uptick in durable goods orders, the last print we got. Average adjustable rate mortgage in the States, bit over 6%. No doubt plenty of people would appreciate that to come down. Really good leading economic indicator. Heavy truck sale. Companies that think orders are going to come in lower, place less orders for trucks. Less goods being moved around the economy. You can see that fell off in 2020 and actually peaked out in 06 before it really rolled over in 07, giving us the clues ahead of the GFC. That's holding up here. Pretty good. 491,000 units sold in the last print. Fed's balance sheet also holding steady. They were talking about slowing down the pace of runoff. There's a look at the inflation rate year over year. Still just kind of tracking sideways at 3. And the unemployment rate, that's what we get to look at tomorrow. Expected to come in 4%. 160,000 new jobs created in February. How is the impact from the federal government workforce getting cut down going to play into this? And that is a bit different from past times because they're kind of been voluntarily laid off, not being fired because they have to, like a private company, because growth is slowing, but because the government is trying to cut down its size and spending. GDP growth currently tracking at 2.5%. Home prices, average house in the States, 332,000, still holding up there, not too far below highs. And finally, just looking at my own economic trends table indicator, we're still pretty much right in the middle here. 13 different indicators. Last month, we're a bullish 7. This month, we're just a little bit bearish. And that's thanks to a bit of weakness in housing, consumer confidence, along with the 2-year coming down, which I designed this indicator to interpret a downtrend in yields as being bearish. However, if yields are coming back because the market's forecasting a lot less treasury issuance, that may indeed not be bearish for the economy. And if the unemployment rate were to keep ticking up, that would be bearish. Really helping up the picture here, bit of a rebound in manufacturing and the bond market and financial stress, still in bullish. So we do have some mixed data out there, but it's not heavily leaning in one direction here. And as you can see, it can flicker around a lot from month to month. But one thing's for sure, for the here and now, the market is nervous, especially going into tomorrow, 31 on the VIX one-day. Jobs report. Things did get really bad in the morning. Jay Powell would have the opportunity to potentially come out, sound a little dovish, and calm things down going into the weekend. We have seen quite a few dicey Fridays this year, Monday gap downs. But like I said, I believe financial conditions are easing. The lower dollar, lower rates, lower oil, financial stress still very low. earnings still very good, and along with the yield differential on stocks versus bonds now growing in favor of stocks, in addition to global liquidity on the rise. All these tariffs are just making the market very nervous, but we are getting some technical bottoming signals and indicators out there. Let's just see what tomorrow brings us. No doubt, could be another spicy day out there. And just a reminder, as investors, it's always best to try and focus on your long-term goals. It's too easy to get caught up in the day-to-day. Obsessively checking your account balance a dozen times a day just creates mental jet lag. Sometimes it's best just to take a step back, go grab a breath of fresh air, and remind yourself what are your goals in the market and what are some realistic expectations you should have with all of that. Other than that, that's a wrap for today. Thanks very much for sticking with Click Capital, and make sure you come back to the channel this time tomorrow because I'll break down everything that's happening and no doubt what could be another massive day in the markets. Cheers.